that is a loophole that the IRS has acknowledged they're not going to do anything about. In this latest round of regulations, the IRS acknowledged, yes, theoretically, you must do the development yourself, or you must do gut rehab yourself. However, based on the literal reading of the law, if you have a developer who put a brand new property up and never used it, and then is going to turn around and sell it to you so that you can use it, that is generally allowed.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grenzig. With me, as always, John Cohen. How you doing?
I'm excited. We got a really good guest today. He knows the internal ups and downs and the millions of questions we ask, but and we call him frequently. But no, it's good. It should be good. It's a good day. We got an operating agreement signed from an investor that took us a long time to shake down. Took us. It was crazy, but we got it together. And another one step closer to getting done. So
there we go. Hopefully those will close soon. We can put those in the bag, and hopefully we can get something new locked up.
Correct.
In the next couple weeks. Or
that's what the focus has been on now. It's new deals.
There we go. Awesome. But that being said, we're gonna bring our guest in. Let him introduce himself. So with that being said, Matt, thanks for joining us.
Pleasure, guys. Especially now that I get to see what John Cohen looks like after advising him for 3 years.
So it's funny, Matt. When I first met, it was with Mike Anspach. It was at one of the one of the RIAs on Long Island. It was talking about 1031s, and we just went through a couple of them. And when he called me, he said, "You got to come to this event. There's a 1031 speaker." I said, "I'm pretty smart in 1031s now. I'm gonna go call this kid's bullshit." And I left there, and I was like, he's fucking smart. He actually knows what he's doing. So that was a long time ago, and I don't think we've met since.
No, we have not. So you were in the audience, but then we didn't get a chance to shake hands individually, and now here we are. As far as Don, I'll have to finally meet Don in person one day, but it's all in due time.
Exactly.
But yes, I'm a proud tax attorney to Toro Real Estate Partners for 3 years now. I am vice managing partner, and I'm chair of the tax department at Falcon Rappaport and Berkman PLLC, where for real estate owners, among others, including those in the private equity space and executives of large companies, both privately and publicly held, and for high net worth and ultra high net worth families, I advise on tax as it relates to real estate, as it relates to mergers and acquisitions, as it relates to trusts and estates, and as it relates to a few other niche subjects. And I'm a pure tax guy, which is a little bit rare when you get outside of the really large firms. I am a guy who knows enough about the other areas to be dangerous, but tax is my game. And among other things, I advise on 1031 exchanges. I advise on opportunity zone planning. I advise on how to set up all of your waterfalls and your allocations inside of your operating agreements, and taking care of all the tax provisions that have to do with real estate investments, among others. So that's my general background. The law firm was formed in September 2018, but now all of a sudden we're 23 attorneys. The tax department has 8 people in it, which is kind of the flagship of the firm. And the firm has offices in both Long Island and Manhattan. It's funny, Long Island's Rockville Center, Manhattan is Rockefeller Center.
There you go.
And we advise on deals and client matters worldwide. I am able to give federal tax advice anywhere in the world as long as it concerns the Internal Revenue Code of the United States of America, as amended in 1986. So that's me.
Specific enough.
In a nutshell.
In a nutshell, exactly. Short version.
Right. So I'm just going to give a little brief warning to everyone. If some of those statements were over your head, we're not going to necessarily take the time to explain everything. So if you don't know what some of those terms were, go back, listen to it, go look it up, come back after you're done. With that being said, what are some of the, I guess, most used tax advantages that you see day to day, just to start, and then we'll just start jumping into stuff?
Sure. So as far as the real estate world is concerned, the topic du jour right now is opportunity zones. It's a program that's part of the Tax Cuts and Jobs Act of 2017, otherwise known as the Trump tax cuts. Here's the basics of it. The basics of the program are basically all about steering private capital into disadvantaged economic areas. That's the theme. So the way the program works is that wealthy individual and corporate investors get a tax break for funneling their money that they get from selling capital gain assets into investments that help out these economically disadvantaged areas that are known as opportunity zones. The big draw is that if you structure your investment right, you get to use capital gain money that you got from selling assets you already own, and you get to use that money to invest in either real estate or operating businesses that are inside of these zones. And if you hold the investment for 10 years or longer, you get to exit tax-free. Totally tax-free. The catch is that any capital gain that you've deferred by investing into an opportunity zone, you eventually have to pay that capital gains tax. But once you've cleared that hurdle and you've paid the capital gain on the asset you previously sold, which you don't have to pay, by the way, until you file your 2026 tax return in April of 2027, as long as you hold the investment long enough, then what happens is you get a tax-free exit as far as the profit goes. So if I got $1 million of capital gain, and if I do it in the right opportunity zone investment, then if that million turns into 3 million, the 2 million of profit comes tax-free after 10 years. That's the gist of the program. It requires real estate development, so it's not really like 1031, which I'll get into in a second, in which I can acquire property that already exists and turnkey, I guess you would call it. If I want to acquire a triple net property where I basically buy the property, sit on it, collect the check, don't really do anything, can't really do that in the opportunity zones. You got to do gut rehab or you got to do development. But once you meet that hurdle, the tax-free profit's a real big draw. So that's been the topic du jour for a while now, ever since the new law passed. But not to be forgotten, of course, is your traditional Section 1031 exchange, which is tried and true ever since the mid-'80s. They came up with the format where you get to sell property, take your cash, put it in escrow, and buy other property. Before that, you had to literally get in a room and swap deeds, so it didn't happen that often. But after the mid-'80s, pretty much everybody who's in the real estate game now who understands the fundamentals knows about Section 1031. Is that area of the tax code that says when you sell real estate that is held for investment or productive use in a trade or business, if you take those sales proceeds and you play your cards right, you can reinvest all those sales proceeds into other real estate meeting those criteria without paying tax on your sale. So if you love real estate as an asset class, you can keep the gravy train rolling for a while. And, the strategy of defer and die is always popular for real estate lifers, right? Because 1031, you get to defer your taxes until you fully cash out and you don't 1031 ever again. Well, if you 1031 for your entire life and you die, you get what's known as a step up in tax basis, which most advanced real estate investors understand what that is. But long story short, it's a refresher on your reference point for paying tax. So you can either choose to, when you bequeath the property to heirs, whether it's your spouse or your kids or somebody else, that person can either redepreciate the property or sell the property within a year of your death tax-free, which is a big deal. So opportunity zones and 1031 are the name of the game, but there's a few other really, really gnarly things that I've gotten into that maybe we can get into discussing on this podcast, or maybe we can save
for sure. So before we get into the other stuff, I just want to touch on some of this quick. First off, you briefly went over opportunity zones. If you're listening and you didn't fully understand it, again, go figure it out, go read up on it, because it is more in depth than that. That's very high level. So make sure you fully understand what it is. Like you said, it's not something you can just buy cash flow and get these crazy tax benefits. There is some nuances you got to understand. So we're not going to go into that.
I'll interject, by the way. I got some written material on LinkedIn that really is very fundamental, and it's introduction from the very beginning. So if you want to look me up on LinkedIn and you're listening, I have some really good introductory material that'll tell you all about the Opportunity Zone program.
Yeah, Matt's done a really good job of making it, I say this loosely, but idiot proof. He's put really good content out there, because, when this first came out, it was people, we're going to do, we're going to buy Class A deals and opportunity zones and never pay a fucking nickel of taxes. It didn't really unfold that way. So I know that because we've used Matt, we have an opportunity zone deal. So we've used him on all of that stuff, and he's really broken it down. We even got him on the phone with our bank because the bank didn't even understand it when we were refi. So definitely look up his content. And we'll put all those links in the show notes also so people have it. But Chris is right. The high level concept is amazing, but dig a little bit because it's a really cool tool, but there's some hurdles that have to be overcome.
Yeah. And I just want to say too, just from my personal, family experience, my mom's accountant, and I hope she doesn't hate me for saying this, but too bad, did not know what an opportunity zone was when she filed her 2018 tax return in 2019. So just because your accountant doesn't know about it or your lawyer doesn't know about it, it is viable. You can do these things. Make sure you educate your accountants or go get one who knows what the hell they're talking about.
Yep.
But I experienced that, and she had to fight and prove it to him. Luckily, she knew enough to, say, hey, you're wrong, and didn't just give up and pay taxes on her gains. But this is a viable opportunity. So if you do have capital gains, you want to sell and potentially reinvest, get some tax benefits, great way to do it. We'll link Matt's LinkedIn page and any other links in the show notes for this. So if you want to go check out his stuff, go in the show notes. The link will be there. You can go check it out. What I'm really curious to hear from you, because as John just alluded to, was when they first announced this back like 2.5, 3 years ago, we sat in the office, we're like, we're going to buy Class A stuff. We're going to cash flow 5%. And, there's going to be tons of money pouring into this. Obviously didn't happen. How have you seen the appetite for opportunity zone investments change over the last 12, 18, and 24 months? And then how do you see it evolving going forward? Because obviously there's some hard deadlines that make it less attractive a little bit as every year marches on.
Timely question, because I was on the phone this morning with the guy who invented opportunity zones. So I was talking to him about this exact topic. Here's my take originally before I spoke to him. Generally, the big winners of this program have been private syndicators like Toro, have been people who like investing in real estate for their own account. I have a large client who's in hotel development. This is a guy who really doesn't take outside money. He never needs to take outside money. He's got access to all the capital he ever needs for any project that he likes. He's got a dwindling list of projects that he actually likes, but he's got access to capital. It's been a home run for that guy too. It has been a home run for entrepreneurs because even though this isn't real estate related in the venture capital space, it is a great, great play. And I've seen a fair bit of activity from those people. And at least there's been, if there hasn't been activity from people I've been speaking to, there's been interest. So there's been a lot of inquiries. There's been some pretty good activity. We have about 24 total opportunity zone deals in this office as far as stuff that my law firm's handling. A lot of other stuff is getting handled by the AmLaw 100, which is that list of really, really large firms in the United States. Smaller firms, it's a little tough to find, thank goodness, because otherwise we wouldn't have as much work. So, there's been some good interest on the private syndication level and the private investment level for people who are investing on their own accounts. CoStar, which is the company that keeps track of fund data, has released their opportunity zone numbers. And even though they saw a bump in Q4 of 2019, based on, Chris, what you've been talking about, which is some of the deadlines to get maximum tax benefits, I don't think they make a huge difference for a lot of other people think they do. Generally speaking, CoStar came out, they said the publicly facing funds that are trying to raise money from retail investors have come up pretty short of their goals collectively. It's been a little bit sluggish in terms of what they've been able to do on the retail side. There's probably been a few elements of that. One of them is the notion that the market has been ripping and roaring, and a lot of people are very reluctant to get out. So the thing about opportunity zones that is not the same as 1031, well, there's many things, but one of the things is that you could sell any capital gain asset going into opportunity zones. For real estate, to be eligible now, after the Tax Cuts and Jobs Act, real estate is the only asset class eligible for 1031 anymore. A lot of people are not aware that 1031 extended beyond real estate. After the Trump tax cuts, that's done. So real estate's the only eligible asset class. For opportunity zones, you can take your stocks, your bonds, your business interests, your artwork, your collectibles, all sorts of stuff, and you can sell them and turn them into real estate, which is nifty. But at the same time, people haven't been selling that stuff because it's only been going up in value. So, who's selling out of the Tesla stock after it went up another 14%?
Every morning I come into the office, Chris, like, you see Tesla? You see Tesla? I'm doing really well on it. I'm like, yeah.
Ride the wave, right? So, people are cashing out of this stuff. I mean, the market just seems to not have a top. You got low interest rates. You got a business-friendly president. You got all sorts of stuff where people are not inclined to sell. So in order for you to be eligible for opportunity zone stuff, you got to have capital gain. In the real estate markets, both for opportunity zones and 1031, it's been a little bit different because New York has experienced now the oncoming leftist wave in the local legislatures and in the state Senate and all those other places. And you have the rent law, and you have changes to the transfer taxes, and you have all sorts of other things. You got a little bit of an oversupply in the ultra luxury condo market in New York. So you got some New York oriented problems where people are now more inclined to sell. So a lot of activity there, and that has led to some capital that eventually went into opportunity zones. But broadly, I found retail to be a little sluggish. When I spoke to Steve Glickman this morning, who, like I said, basically invented this program, Steve said, look, I'm very optimistic about the idea that now that the IRS passed final regulations around the program 2 months ago, and people have a lot more clarity, especially on the institutional level and for very, very large corporations, that will now, he said, unleash the floodgates in terms of a lot of well-moneyed players who are very conservative coming into the marketplace now and getting heavily involved. And what he felt was really not out there in terms of ideas, which I think he's right about, by the way, is venture capital. And I don't want to veer too far off real estate for purposes of this podcast, but I think there's a lot of room for people to put venture capital into the opportunity zones because the upside's too good to ignore. If you can get tax-free profit on the next Google, that is, you can barely even quantify what that value is worth. And I think the word will get out there on that stuff. So let me summarize this into one sentence. Private activity has been good, but public activity has been a little sluggish and might pick up if there's a market reversal or there's a better chance of getting the word out there, basically.
Yeah, because I think, and correct me if I'm wrong, and I know we saw it when it first came out, like everyone and their brother wanted it. Then the rules weren't out. So it had a stagnation period. It just sort of fell flat, like, yeah, this was a good idea and concept. But now that the rules are out, we spoke about this the other day. I've gotten the emails back in the inbox, and people have been reaching out again. It sort of went dry where people they didn't know and no one was asking. But now that the code is finally done, it seemed to have picked up a little bit. So I think that I agree. I think that now it's let's call it as concrete as it's going to be. Now I think people understand it more. I think it'll come back around. But with that being said, it's already a year and a half, 2 years, into its life.
Yeah. No, I think it's interesting because we can go a little bit outside real estate because it all kind of relates. It doesn't, we just did a whole episode where we basically talked nothing about real estate. But basically what you're alluding to is that the opportunity zones doesn't necessarily have to be in real estate. It can be businesses in these zones as well, correct?
Absolutely. I was going to mention, by the way, regarding the IRS regulations, you guys remember what I advised you the minute this law came out, and what I said to you guys was, don't wait on the government.
Yep.
That's why you guys have me. Don't wait on the government. And as it turns out, we were doing that Ohio project. That Ohio project was in the works ever since early 2018, before the regulations even came out. People in your circles that I've advised that did projects before the regulations even came out. Guess what? The regulations are out and everything's fine. So it's a lesson to be learned, certainly for any future program like this, because the tax laws are going to change. That's just the only constant in my business. And it's generally when the government has a program like this that they want you to use, it is not prudent to try and wait on them to get in there and clarify it. Pretty much any reasonable interpretation of what they've already put out there is going to be fine. It's a different story when they're putting something out there that's more punitive, like carried interest, which maybe we'll be able to discuss today and maybe we won't. But on carried interest, you can tread lightly, and that's all good. But for opportunity zones, in my mind, anybody who was going to be ultra conservative about this was missing out.
I agree with that, because I think, that's why we pay Matt is, anytime, in those, but I don't want to call them gray, black and white or whatever it is, but you want a guy that's going to go to bat for you that can at least defend your position at the time you did it. And that's really what it comes down to. But this was something that the government put in place to benefit. So with nothing being in place prior to, you have a good argument for what you did. There's other things in tax code where it's amendments and stuff where it's a little bit more, you're not going to get away with that. But that's why we have Matt on our team, because I don't interpret the tax law. Matt interprets the tax law and gives me the whys on why we can do it. And then I go out and do it. But that's, in this particular case, I happen to be a fan of it as well. I think that, going out of the box, we didn't know what we were doing early on. And when we bought the deal, it was a friend of mine that said, hey, you should check if it's in an opportunity zone. So right before we bought it, I looked, I said, oh, wow, this is going to be really beneficial to us. And it's going to turn out to be a really solid deal. So I'm excited, but you're going to ask a question.
Yeah. Can you just, I think I understand, but can you just clarify what you mean by the retail investors that are slow to moving? You're talking about like the individuals that have X amount of dollars in the market, or something different?
It's people with brokerage accounts at major wirehouses.
Right. Okay.
It's people who are not real estate lifers, people who are not entrepreneurs, people who might be highly comped employees at major companies, people who are generally executives, people who don't make it their day job to know all about the real estate market, all about a certain sector of business. They don't necessarily own equity in the companies, or they may have proceeds from the sale of a prior business, and they're kind of like taking it easy and living on the income from their investments. It's those people. It's people that might even have only, compared to what the circles that we run in, moderate net worth, people who are between the area of $500,000 and $5 million. It's people who just don't have the same inside information that a lot of other people are dealing with. That's really what I mean by saying the retail public. They got to get their information secondhand from somebody else.
Yeah, absolutely. So I think it's interesting, and I have a slightly different take than the reason why I think retail investors have moved into it. Over the last 3 years, as I've been doing this with Toro, when I try to explain to friends, family, people I meet what I do, a lot of times the first 5 minutes that I explain to them or tell them what I do, they don't get it. They don't know it's an option. Two, they don't understand how it works. They don't really know that it's a thing. And then I have to kind of explain it to them, and I have to explain it very simply. Like oftentimes I'll break it down as like, do you know someone that owns a house and that rents out? And they're like, yeah. And I'm like, okay, they go out, how you buy a home, you get an 80% mortgage. It's the same concept, but we do it with 100 units, and the value is just based on the income and expenses. And they kind of get it. And some people get it more than others, depends upon, how financially savvy they are and stuff like that. My gut, just from having a lot of those conversations, is that because a lot of people don't already know about it and how hard it is for me to explain what an opportunity zone is to people who already know real estate, I think it's another layer on top of that complexity that people don't understand what it is, so they don't even think to do it. They just stick with what they already know, and they don't want to spend the time to go out and do it. I'm sure the market does play a part, right? If you're up 200% in Tesla, you don't want to sell to go into a 10-year play in real estate. But I also think it's, the explanation of it, it takes me dozens of minutes, if not, half an hour, 40 minutes to explain how the tax benefits work in an opportunity zone before the retail investor, someone who's not in real estate day to day, or even, in multiple investments or has been investing for a while, that they, fully or mostly understand how it works. I'm curious, from your standpoint, if you agree, disagree, or what your thoughts are on that.
I think that's generally correct. I think based on the way that the program's been drawn up and how all the regulations work, the IRS is basically given an impossible task because the way that the Trump tax cuts were put together is very quick. So you have maybe about a month's worth of thought going into that. I mean, let me compare this, by the way, to the most impactful tax reform that occurred before this, and that was Reagan, the Tax Reform Act of 1986. It was Reagan and Tip O'Neill. So how long did that one take? 3 years of back and forth between what's known as the Joint Committee on Taxation. That is Congress and their members that are responsible. It's House Ways and Means and Senate Finance. They're the ones who actually write and pass the law before the president signs it. Joint Committee on Taxation, super important for that stuff. Then you have the IRS, which is, of course, the body that enforces the law. A lot of people are not really aware of those differences. The IRS doesn't make tax law. The IRS enforces tax law. The regulations that the IRS puts out are meant to clarify and tip off taxpayers as far as how the IRS is going to go about applying the law. The IRS doesn't write it. Congress writes it. So you got Joint Committee on Taxation. That's all the members of Congress that are really responsible for writing the law in committee. You can horse trade in Congress so that other members of the House and the Senate can have input on tax laws, but it's those committees where the laws are born. Then you have the IRS, and then you have the private sector. And a lot of people are not aware between the practitioners like me and lobbyists for various industries that are affected by tax laws, how much input the private sector has on the way the tax laws are written and the way they're administered. By the way, for a lot of people that are uninitiated, that sounds like really corrupt. Like that sounds like gracious, right? Like
I was going to ask, can you explain that? Yeah.
It's not, that's not really it. It's, you want to make sure that if you're in an industry like real estate, if Congress is going to change the law and it's going to affect you, you want to make sure you got your 2 cents in there. Because one of the major examples, by the way, was Dave Camp, a Republican congressman from Michigan, who was not a member of Congress by the time that the Trump tax cuts were passed. But in 2014, he proposed a bill that was going to repeal 1031. 1031 repeal was on the table as a revenue raiser for the Trump tax cuts so they could offset some of the hit that they were going to take to Treasury for some of the other things they did. And it was the real estate lobby and specifically the 1031 lobby that came in there and said, guys, this is a bad idea. And eventually 1031 was kept for real estate only. They got rid of it for artwork. They got rid of it for business assets. They got rid of it for a lot of other stuff. But they kept it for real estate. And the only reason why is because of the private sector's input on stuff. So generally, all three of those bodies, Congress, the IRS, and the private sector, all get together, and they're all supposed to make these laws in tandem. That will still achieve very important policy goals. A lot of real estate owners are very familiar with the passive activity rules. Everybody's been through that. If you're a real estate lifer, you've been through passive activity at least once in your life. That was from Reagan, and the reason why Reagan passed passive activity laws in '86 is because, you know, and people who have really been in the game for a long time who are listening to this will remember these days. The days where you would do non-recourse financing on buildings, load up on your tax deductions, and then basically walk away from the building without having to recognize your fair share of income, and you'd walk away from the building having gotten insane amounts of tax benefits for the equity you put in. I mean, if you go 90% financing on a building and you put $10 into it, and you get $100 as your share of tax deduction, you're gonna come out ahead if your day job is like being a doctor or being a lawyer or being an accountant, where you're just getting like slammed on a W-2 and you got a really high tax rate. And a lot of these people turn around and say, what can we do to shelter this? They go into real estate, or they go into planes, or they would go into all sorts of stuff. And they go non-recourse financing. They load this stuff up. It'd be tax shelters all over the place. And at the end of the investment, they find the right time to basically walk away from the building, and the government would lose out on a lot of money. So tax reform in '86 was basically about, all right, get rid of that stuff and we'll lower your tax rates, and we'll all come out a little bit ahead. And to draft these rules, it took like 3 years. So I'm going to loop this back to our original topic: Trump tax cuts, opportunity zones. When you put like 1 month's worth of thought and you don't go to the IRS and you don't go to private practitioners, everything is going to be a disaster. And the opportunity zone laws were, as far as the quality of the drafting of the law itself, it's a disaster. And the IRS can't change the law. They can only come out there and say, well, given what was written, this is the way we think it's supposed to work. So getting back to Chris's original point, if you're at a cocktail party trying to explain how the hell this is supposed to work, you have no hope.
Yeah.
Because it's, I try to boil it down to, okay, defer your capital gains until you file your 2026 tax return. You might get a haircut based on when you invest, and you get tax-free profit after 10 years. Fine. But then you go into the real estate part, you turn around and say, well, you can't do just investments where you sit on them. You got to do gut rehab, or you got to do ground-up development. All right, what if I already own the land? Can I develop my own land? Yes, but you have to put a master lease into place. But the master lease can't have prepayments on it, because then you're funneling stuff out of the opportunity zone. They don't want you to do that. So, and you start getting into all the variations, and people's heads start spinning really, really quick. I mean, on every single aspect of this. All right, what happens when I sell my assets? All right, how long do I have? Wait, but why does it depend? But, and there's so many different permutations that by the time you're going down 18 different paths about what people are supposed to do, they don't even remember what you told them in the first place. That's a big barrier to people actually putting money into this thing. There is no way to make it so easy to digest that you can give people a summary that's like one size fits all. It's impossible.
Yeah. No, and it makes it very tough for us, because we've already got a barrier, and it's convincing people that we're not a Ponzi scheme, right? Mm-hmm. I say that because I was watching American Greed last night, and they were talking about
I saw the
Staten Island guy doing a Ponzi scheme. But that's a real barrier. People have to trust us that we're not going to fuck them over. And then now on top of that, I've got to now explain this complex tax code, make them feel that we understand it enough that they're not going to have to pay an outrageous tax bill that I'm telling them they won't have to, because I know what I'm doing based on a law that may or may not be poorly written. And it's like, that conversation is huge. I mean, it's a mountain.
I'll take a step back. I have extremely close friends and family that to date, and I've been doing this for, a decent amount of time now. It's going on, 10 years, real estate, raising money, buying deals. I have friends that literally come over to me and say, how's them? They think I'm a real estate broker. They're like, oh, so you sell any deals lately? And I'm like, no, I don't even answer them anymore. It's like, how's the real estate market treating you? I'm like, that's not really what we do. But
that's what I was talking about. When you go to people, they just don't understand what it is, because anybody that's in real estate, 90% are real estate agents.
Correct.
So it's like trying to get over that battle with somebody who doesn't know what you're talking about.
Yeah, I got people I've known for 7 years thinking I'm a real estate broker. Now I'm going to go try and explain to them, an opportunity zone investment. It's like, it's tough. So I think we're all saying the same thing, but I know it's the biggest takeaway is more or less that the Reagan Tax Act, which was basically how everything was written over the last 20 years, it was 3 years putting it together. The Trump thing came together in months, and it was like, boom, done. So it was like overnight. And it wasn't just the opportunity zone. It was also like the tax cut. It was all of it. So like even our accounts, like K1s were backed up. They had to like reinterpret the law in a month and a half, and it was changed. And they had to go file K1s and file tax returns and business returns. And there was so many changes that it was like a fire drill. But,
Yeah.
So my favorite description of the Trump tax cuts came from Paul Ryan's, because Paul Ryan, he once went on record saying his dream job was being head of House Ways and Means, which eventually he was. And Paul Ryan's counsel, who advises him on tax stuff, described an early version of the bill as, and I quote, dropping cash out of helicopters onto corporate headquarters. And it did not change materially from the time that he said that until it got passed. And that has basically borne out to be true in the early days of the Tax Cuts and Jobs Act. I mean, yes, has it been good for real estate? It has. but that is nothing compared to how good it's been for the Fortune 1000. If you take a look at what's happened to their profits ever since the passage of that law, it's been a bonanza. That's been affected through the way the stock market has gone really gangbusters. But there's always going to be a debate, which we will obviously not have on this podcast, about whether the stock market properly reflects the overall health of the economy, et cetera, et cetera.
Yep.
But we are feeling in the tax community, it's now filtered down to us, really, to deal with everything about the Tax Cuts and Jobs Act. There's a lot in there on real estate. You know what regulations just came out that I'm going to admit I haven't even read yet? Interest deduction limitation. That affects real estate. That affects syndicated real estate deals like Toro's doing. The interest deduction limitation regulations came out, I think, a couple of months ago, and I had to choose between that and opportunity zones, and I went with opportunity zones. But I'll eventually read the interest deduction limitation regulations, but that's a big thing. Who's really left to deal with that? Us and of course Wagner and Zwerman, who advises you guys on the accounting side. But it's us. I mean, that's not, lay people don't have to deal with that anymore, but it's us. And I can name 1,000 other aspects of the law where we just turn around, we're just like, how do we make heads or tails of this? And the answer is usually do the best you can. Make a judgment call, do the best you can, then see how it all turns out. It's pretty much all you're left with.
I hear you. So I actually have a little interesting piece of opportunity zones that I heard, and I'm curious how true it is. I had an agent in Indianapolis reach out to me about 18 months ago, and he said if there was a development in an opportunity zone that the developer did not take the benefits of the opportunity zone, if you bought the condo, you could then gain the benefit even if you're not making improvements.
That is true if the facts are right. So let me give you an example. I had somebody approach me, develop self-storage, and they said, we're in an opportunity zone. We're actually going to complete construction and get rid of this thing right when the CO comes. That is a loophole that the IRS has acknowledged they're not going to do anything about. In this latest round of regulations, the IRS acknowledged, yes, theoretically, you must do the development yourself, or you must do gut rehab yourself. However, based on the literal reading of the law, if you have a developer who put a brand new property up and never used it, and then is going to turn around and sell it to you so that you can use it, that is generally allowed. So the way it works is if the developer who built it did not depreciate it or did not otherwise place it into service, which would make it eligible for depreciation, the answer is that somebody could come and buy it in their own opportunity fund or their own opportunity fund subsidiary and get the opportunity zone benefits, even though they themselves didn't do anything to it. I was surprised that the IRS actually sat on that, but truth be told, they did. I should put, by the way, what kind of lawyer would I be if I didn't put the standard disclaimer that the podcast is not tax or legal advice, so please don't run around and then you can sue me.
I was about to say it only took you about 30, 40 minutes to put that in as a hey guys, I'm going to talk about
we're going to cut it out anyway, so.
But your Indianapolis contact did have it right, and I was looking in the final regulations to see if they would zap that out, and they did not. If you have a Class A building that's got leases but they haven't moved in yet, would that qualify under that bucket or no? No. Well, I mean, once you got the leases, generally speaking, that's placing it into service. That's
all right. So you have to. So basically, you can't pre-lease or anything.
I'm reasonably sure if you got leases in place or people haven't moved in, that's a no-go. But if you've completed construction, waiting on your CO, I mean, well, I got to tell you something. I'm speaking without enough knowledge of the depreciation regulations.
Yeah, I know it's going to be more complex than that, but.
Yeah,
put it this way: he wasn't complete. He wasn't
lying.
He wasn't completely wrong. He just knew even less than you did, and was like, "No, you can definitely do this." Decided to ask me for some reason, and I was like, "I have no fucking clue."
Well, yeah, when brokers are telling you, okay, they're always 100% sure. All right. If
Yeah.
it's going to close a deal for them, the brokers are always 100%.
Oh yeah, no, yeah. It's
Well, to be fair, this was, it was a guy selling a condo to another client. Somehow my name came up. I talked about opportunity zones once when it first came out because someone was asking me, called me up and was like, what do you know about this? And I was like, I don't fucking know. I was like, Dad, go talk to a guy who does it. Go talk to Matt. And he was like, okay. I was like, I've never heard of it. So I was just curious. So it sounds like it's possible, but most likely improbable and would be a unique case.
You got to be planning it with the seller. Sellers got to be close to construction when you come to them and you're just like, hey, what do you think? So, yeah, you can expect that the seller is going to bump up the price because that's what the self-storage guys are doing. I mean, the guys who asked me, they turn around, they said, they put a 15, 20% premium on the price. And they'll get it because you got somebody in there who's got a sure thing. You don't have to get in there and you don't have to have stagnant capital for 2 years while
it's built.
The
heavy lifting's out of it. It's built. All you got to do is occupy it and hold it.
Yeah, I mean, you got lease up risk, but
yeah.
So that was another thing I was going to say. Have you seen when you've been talking with some groups, and I don't know if you get into this, have you seen anybody's return expectations change when they're looking at opportunity zone deals?
No, is the blanket answer to that question. They have the same return expectations that they do when they're looking at a retail investment. I've seen a couple of syndicators basically say, well, it's OZ and people can maybe expect a lower return because it's tax-free. But the only times that has happened has been impact investing, where people are comfortable with the idea like, yes, I'll take a couple ticks less on my IRR because I am doing drug rehab or I'm doing housing for workforces and ethnic minorities and et cetera, and so on down the line. Those syndicators have had success doing that. But for regular old investments, people have had the same expectations. You got to realize the program's useless without profit. So a lot of people are examining this saying, I got to make sure that this investment's going to profit. This is not like low-income housing tax credits where you can turn a bad deal into a good one. Deals still got to be good. So the expectations are basically the same.
Yeah. I think that's an important point because I've been sent I've seen one or two broker developments in Puerto Rico. Don't know how that came across my desk, but they were giving 10-year tax adjusted returns. I was like, who the hell is going to look at that and go, oh, because I'm paying no taxes, I'll take 5 basis points less on my return. I was like,
I got one Puerto Rico deal, and that you got to realize you cannot 1031 into Puerto Rico. So I had a gentleman who is from Puerto Rico sell a very nice portfolio in the Bronx. And he came to me and he said, so 1031. I said, okay, where are you looking to go? Looking to go back home. I said, you can't. I said, Puerto Rico for 1031 purposes is foreign territory. You can't go from the U.S. to foreign or foreign to U.S. So I told him, I said, listen, the whole island's basically an opportunity zone. Because what's that? I ran it down for him. So now what he's doing is he is developing an office building, and next to the office building, he's putting a parking garage. And I said, yeah, sure, that's qualified for opportunity zones all the way. So he's using his own equity, still looking to secure financing, but he's going to Puerto Rico. He's doing a Puerto Rico project, and that is the only project I've ever heard of where people are going to go into Puerto Rico because the guy's from there. He knows the area. He grew up there. He visits frequently. He understands the market. And for any of those people, you'll be able to get a good deal for yourself if you understand any market really well, just by informational advantage. But people just who are trying to tag on to one of these deals for investment returns, that's a tough sell.
Yeah. But it's interesting, though, because I had a buddy whose family's from Puerto Rico, and he said he knows several families whose houses have been getting bought up in the last 2 years. And I said, good shot. It's because the opportunity zone stuff has come out. So there might be people moving into it. I don't know.
It's the whole island.
No, I know.
A special carve out in the opportunity zone statute that basically says, for lack of a better explanation, the whole island is an opportunity zone with the exception of that, like part of it with like the Ritz-Carlton residences on it. Like that's not enough. Other than that, basically the entire island is an opportunity zone. I can't remember whether that had to do with Hurricane Maria or it didn't, but they designated like the whole island. So if anybody has any interest in getting down there and redeveloping the island, you can get tax advantages for doing it. Yeah. Not to mention, of course, the whole notion that under certain circumstances, if you domicile yourself in Puerto Rico, you could be almost exempt from federal income taxes.
Going to Puerto Rico. Matt, we have a whole other conversation.
Lots of people have said that, but you need to meet certain conditions. It's not quite as easy as people make it out to be. But
that's why I'm calling you tomorrow. We're going to Puerto Rico, Toro, Puerto Rico.
New headquarters.
Yep. Use the OCs. Build yourself a business there, and then make your relocation to Ritz-Carlton residences, man.
No, but it's just. I know from our standpoint that the whole lower your expectation thing. I never thought it would work, and that's sort of where there may be a disconnect also between investors and not, because it's a longer term hold, but people still want. The people that are going into opportunity zones with the money, they're not stupid, so they're not just going to give away their profits because they don't want to pay taxes. They still got to pay, so they want the investment to pay off.
Yeah, no, I think the other thing too is nobody talks about after tax returns. So all of a sudden, now that it's in your benefit, you're going to start selling deals on after tax returns. Like none of our underwriting or performers or books is like, oh, you'll make an 18 IRR, and after tax, it's I don't even know what it would be. What, 13, 14, 15? It doesn't matter. It's individual. But now you're going to say, oh, no tax benefits, so we'll give you a 12. Like, you can't have your cake and eat it too, basically.
Nope. I also feel like, by the way, tying up your money for so long basically offsets the pre-tax return element.
How do you figure?
I get to get tax-free return, but after I've locked up my money for a decade, so it kind of like offsets as far as what people demand.
Yeah, I wonder too how much that's going to play into the retail side of things, because you
have to leave it there.
Yeah, because we had a group we know that famous for buying deals forever and just refinancing with their own money. When they started syndicating one of their deals, they said 7-year hold. They were short equity. They dropped it to, I think, a 5, and they raised the equity like that. And a lot of their investors they already had committed doubled up. So I wonder too, from like the retail side of it, how much people really want to commit money for 10 years and potentially longer.
Yeah, most people, at least on our side, they want 3 to 5 years. They want out. They want in and out. It's like it's instant gratification. The market's been so good for so long. People have been in and out of anything, like a Bitcoin. I mean, it was like, oh look, one day I bought it was $1,000 and it was 20,000, right? So it's like people want such fast returns that when they look at 10 years, I don't want to be married to that. So I think that's going to be another challenge.
I think part of it too is right when you're talking retail, if people are worth call it 500 to 5 million. Your check size isn't going to be huge, that the cash flow you're going to make on that deal for 10 years is changing people's lives. So I think it's going to be more suited towards, the people that are writing 7-figure plus checks where, if you're making 7, 8, 10, I don't know what cash flow people are making, but at least that's significant money, right? If you're, $1 million, 6% is 60 grand, right? That's not, if you're writing $1 million check, 60 grand is probably not changing your life, but it's also decent money. If you're writing $100,000 check and you're getting $6,000 a year, I don't think that's changing anybody's life. So
I have a question, Matt. And this is something that's come up a couple times. People have asked me, I know you have to pay your taxes in 2026. What if you don't have the money to pay? What happens?
You still owe the bill. You've got a federal tax lien that cuts across everything that you own. So
that, but that's like from a sponsor standpoint, like if one of our investors doesn't pay, how does that affect me?
It doesn't.
It affects that they basically, they'll have to pay that.
It's an individual thing. It's, all right. The bill is on their tax return. If the IRS gets a federal tax lien on your investors, they cannot force the fund to sell. It's going to be a problem for the investor who lacks the liquidity. But generally speaking, if you're a sponsor, and of course we've had conversations about this, your plan is to do a cash out refinance
exactly
time in advance of that 2026 recognition event, so that everybody has money in their pocket. They can't come back and complain to you that they don't have enough to pay their taxes.
Yeah, we told them that going in, basically, hey, the plan is to refi this. At that point in time, I don't know how close it's going to be to 2026, but if it's 2024, 2025, whatever, 2023, I'm giving you money back. You can't come knocking on my door for it. And as long as it doesn't affect me, we're going to cash you out. I mean, we were aware of that, and we wanted to address it early, but I know that's been the question, like, what happens if I don't pay, or how does that work? And it's like, well, that's your own problem.
It's like any other tax.
Yeah, no, I know, but sometimes it gets a little crazy, and you never know. And the last thing you want is you have 10 investors, one guy doesn't pay, and they,
yeah, obviously, if it's going to put you in a bind, then it's not so easy anymore.
But
awesome. I know we kind of just talked about opportunity zones, but I think that's a really great place to wrap it up. Maybe we'll do a part 2 to talk about some of that other stuff, in a few months or, later down the line.
Happy to come back.
Yeah, Matt, thank you so much, for sharing your insights, your knowledge and stuff like that. I know you mentioned your LinkedIn, but if people want to get in touch with you, learn more about you, hear some more of your, content, stuff like that, where's the best places to do that?
Besides LinkedIn, I always encourage people, everything is crazy between the hours of 9 a.m. and 6 p.m. every day. So the best way to reach me is always email. So the email address to reach me is my initials, mer@frblaw.com. That's Frank, Robert, Brian, the word law.com. And you can send me an email at your convenience. One of the things that I do, that if you're a listener to this podcast, or if you're somebody who was referred to me by someone I know and trust, is I answer short questions for you. The answers are not legal or tax advice, but they're meant to give you general information that can help you proceed with whatever plans you want to do, or help you get over a hurdle that might make or break a deal. And if you want to ask a question, if it's going to take me more than 5-10 minutes to answer, I'll let you know, and then I'll say, listen, for whatever reason, I might need to be engaged, or it's more complicated than that, or something along those lines. But probably 65-70% of the time, I'm able to just be like, look, as a matter of general information, here's the answer to your question, and if you need more details, you can always contact me further. So that, I feel, is one of the things that's unique about us, and it's one of the major ways that we built our firm, is that we hold ourselves out there with that level of openness. And a lot of lawyers, I think, are a little stingy with their time, which I can understand, because the time is the way that we all get paid. But as a matter of business development, we are very big on the whole idea of, like, look, see us as a resource. See us as a sounding board. Get a little taste of what we're able to do, and hopefully that will build up our image in your eyes and solidify the idea that we're the right people to help you out with your real estate project. Or, we get involved in a couple of other things, as I mentioned at the top of the podcast. Private equity, we get involved with trust and estate planning pretty much all across the board, and other related stuff like administration and litigation. And it's, for us, look, we're very, very fortunate that as the economy has really blown up in the year and a half since we started the firm, we've experienced a lot of growth, and we're hopeful to continue that.
Awesome. So to boil it down, follow him on LinkedIn, hit him up by email if you got any questions. This was fantastic. Thank you so much. We're definitely going to do a part 2.
Happy to be here, and looking forward to being back.
Awesome.
Thanks, brother.
Perfect. Thanks, man.
Good
that was
stuff,
great.
Man.
Awesome.
Cool. It should be out in probably like 2 or 3 weeks. So I'll be sure to email you.
On Spotify, so I'm going to hear myself on Spotify now.
Yeah, there you go. Yeah, it'll be out on everything: Spotify, iTunes, Google, YouTube. I'll give you all the links. If you guys want to use any of the video for your own stuff, if it's LinkedIn or your website or anything, feel free.
Cool. I will. I'm going to put Mary in touch with you guys and see if we can get that together.
Awesome. Cool. Yeah, when it's out, I'll just send you the link. If you guys want the raw file, I'll just share it. It's on Dropbox, so you guys can have access to it too.
Fantastic. I got a corporate Dropbox, so.
Perfect. All right. Cool, man. We got to run, but thank you.
Awesome. Enjoy the evening, guys.
Thanks, buddy.